You've been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Hey, Jason here. Today we're going to start a case study on Tiffany and Company, stock ticker TIF. We're going to do analysis of the buyout that they've agreed to be bought out by Louis Vuitton for a share price of $135 million and a valuation around $17 billion total. We're going to evaluate that from the beginning to the end in this kind of mini-series of videos. Today we're going to focus on the preliminary analysis, my preliminary analysis checklist, which you can see over here on this page. Okay, this is from a previous company, so we'll redo all of this, but this is the exact process I go through every time I evaluate a company. I want to show it to you today because it saves an enormous amount of time and it covers an incredibly wide-ranging area of metrics, balance sheet, cash flow statement, everything. And we'll just do the quick preliminary analysis today. Next time I'll explain a little bit of everything more in depth. Then we'll do valuations of Tiffany's to see if Louis Vuitton overpaid, if they got a fair price, if they underpaid, who got the better part of the deal, like we did with the Kylie Jenner video a couple weeks ago. So let's get to it. Alrighty, so 16.1 rounded up. And I'm going to go kind of quick in this video, and then I'll explain everything in a future video. Okay, so operating margin 5-year average operating margin. Margins come down by about 2 percentage points in the last 5 years. Not a huge deal, but something to note and something to talk about. Of possible importance in coming videos. 1, 2, 22. Fell. Percent. Oops. Because ROE is higher than ROIC, I know the company has a decent amount of debt. And because it's fallen in recent years, I also know that their debt level has lowered. We'll get into how I know that in future videos in this series. Okay, about double here, the 5-year average compared to the trailing 12-month period, so we'd want to figure out why their cash flow is so low here in recent years compared to the previous time period. Okay. 420 days rounded up. 10, 69, 9 days. I can tell just from this number, well, this section combined, that they may be having some inventory issues, that they may be having issues selling their products, that their products might be overpriced, that their brand value may not be as valuable now as it used to be. Again, we'll cover this in a future video, and I'll explain how I can tell you all that from just this one number, or one set of numbers. Okay. EV. Let's calculate it out down here. 16.1. Just round up, make everything easier. Financials tab open. Forgot to do that. So this is in billions right there. So that's what is that, 86. short and long-term debt. Okay, so 0.99 in long-term debt. Preferred stocks, do they have any of that? They do not. This is 0. Minority interest. Leave that at 0. That's negligible. This number being higher than this number means the company is potentially overvalued here. In this case, it's not that big of a deal. There's sometimes you'll see this is way like double or triple or half the value or even negative value. So this is not that big of a deal either way. Okay, so let's finish up these notes. Back over here. Make up 10.8%. Short-term debt makes up 2.2. Long-term debt makes up 14, rounded up. Okay, this is important just so I know without having to look all the time if the company has a net debt or net cash position. If it's a net debt position, there's less lower margin of safety. If it's net cash, that means there's larger margin of safety because the balance sheet is stronger. Okay, let's go back up here. Finish doing these. 16.23. 16.23. Okay, what is it? EBIT, income statement. There's operating income. 0.74. Let's get the free cash flow real quick. Cash flow is negative. That doesn't sound right. Because their free cash flow to sales margin is positive. So why is there a difference? Interesting. Well, we'll get into that in the next video. For now, what I can do is go over to here. So 6.67% times their revenue, 4,385. And they have about $292 million in free cash flow, so that's 0.29. So that's another way we can figure out right there. 21.9. $55, $56 rounded up. $56 rounded up. And these mean that I would find or I do find on a relative basis that the company is massively overvalued right now, and I'll illustrate that with this, with the earnings yield. So 4.6%. And 1.8% rounded up. So this video is now 15 minutes. I've evaluated the company on a preliminary basis from top to bottom. I've done relative valuations on the company, and I know the company's in net debt position. I know from this 15 and a half, 16 minutes, that in my opinion the company, while great from a margin perspective, is likely massively overvalued from here. I look for numbers below 8 here, and I look for earnings yields above 10% usually. Earnings yield shows you the amount, if you were to invest in the company today, the amount you could expect to earn based on the profitability metrics compared to the company size. In this case, enterprise value. 1.8% based on free cash flow, 4.6% based on operating profit. So on this preliminary analysis, I would not continue normally because this company looks to be massively overvalued. Its margins have dropped. It's in a net debt position. Yeah, there's not enough here for me normally to continue doing research on this company, but because they got bought out, I want to do a case study on it. So next time I will explain more in depth why these things are here, what they mean, what they show you, where they show you to look, where they show you to look for further information, all that kind of stuff. I'll show you, or I'll tell you about all that in the next video in this little mini series. Until next time, let me know your questions in the comments below, and I will try to answer them in the videos to come. Make sure to like, love, share, comment, and subscribe, and hit the notification bell if you are watching on YouTube. Also, if you're listening to this on the I Love Value Investing podcast, make sure to like, love, share, subscribe, and comment as well. I really appreciate it. And I'll see you in the next video in this series. Thanks for watching. Have a great day. Talk soon. Bye.